Good afternoon, traders, and welcome to today's Q&A. And in today's show, we've got 4 questions from 4 different people. The first question is from Wagner. And Wagner writes, really like the videos that you keep posting, keep it going. I'm not able to day trade due to my job and would appreciate if you could cover some ideas about trading the FX markets around normal job hours and enable me to be a full-time day trader. Well, there are a couple of things in there, Wagner, that sort of contradict one another. So first of all, you want to talk about some options for being able to trade full-time or to trade the markets around a normal job to allow you to be a full-time day trader. And that kind of they don't go directly together, if you know what I mean. Basically, first of all, if you do have a full-time job, there are many different things that you can do to trade around your job. And first and foremost, you're going to want to start to look at a longer term time frame. So, your minimum time frame really is going to be a 4-hour time frame. And then you'd probably be looking at the dailies and things like that for your directions, your entries and everything. But you wouldn't want to go anything beneath a 4-hour time frame. And the good news for you is that many people manage to do this. We've got a number of members in our community who trade full-time jobs, but are also very successful trading the longer term time frames. And what they typically do, and what you will need to do, is you'll need to have a schedule. Okay, so it won't be sort of just turn up to your charts and trade whenever you want. You want to have a certain time each and every day that that you can put aside for your trading, whether that be in the morning, in the evening, at lunchtime, whatever that is, it doesn't matter as long as you're consistent in that approach. And then you don't need to spend all that much time in front of the charts. If you're looking at the daily charts, they don't change that often. In the beginning, you might find that you're spending a little bit more time looking through the different charts and analyzing them and coming up with the story of the charts. But once you get used to it, you'll find that really and truly, because it doesn't change that often, you're spending maybe half an hour a day on your trading and you'll still be able to derive a very good income from that. Then the next part you said was to do with becoming a full-time day trader. And that's a completely different skill set. And the reason that I bring this up here is that not that you can't do that, and not that you can't use, the technique that I just talked about, using longer term time frames to get you to a point where you can be a full-time day trader. But what I don't want you to sit there and think is that, okay, I'm great with the longer term chart, so that's automatically going to translate down to a shorter term time frame. Even though the strategies may be transferable, from a psychological perspective, it's a completely different ballgame, and it's something that will take some getting used to if you're going to move from a daily chart down to a 5-minute chart or something like that. So to summarize, in order to be able to trade around a full-time job, what you're going to need to do is basically trade from the longer term time frame, so a 4-hour chart or a daily chart, and make sure that you're just consistent in your schedule. And once you do that, then you'll be making the right steps towards where you want to be. Okay? So I hope that answered your question, Wagner. The next question is from Richard, and Richard says, in spite of watching a lot of your flow trading videos many times, I still do not really understand what you mean by market energy. Perhaps you can explain it in a different way. Now, this is a very good question. I talk about market energy a lot. It's one of the things that is sort of the primary reasons for me to get into a trade, regardless of whether I'm trading a shorter term chart or a longer term chart. Whatever it is, market energy is one of the fundamental things that I look at when getting into a trade. And ultimately, what I mean by this is that the market, you have an expectation of what the market is going to do, right? If the market is moving up, you'd expect it to be breaking out to higher highs and printing higher lows all the way up. If it doesn't do that, or when it breaks out of a high, it fails to there's no real momentum there. And then it starts to pull back a little bit. And then it goes to break out, to another high, but it doesn't quite do that. And then it pulls back a little bit again. That's what I mean by the market energy. It's understanding what the dynamic of the market is at the time. So if it is in a nice trending environment, then you would expect the energy of the market to be printing higher highs and higher lows with really not so much in its way. So not much resistance there, if you like. But if you're in a trending environment and suddenly the market is failing to push out to those highs with any real momentum and it's struggling. And you can see in the price action there, every time it goes to break out to another high, it's not doing it by as many pips. and it's not doing it as quickly, and it just seems like it's a little bit of a labored move, that's telling you something about the markets. And one of my favorite trades to get into is one of those trades where, for example, you are expecting it to break out to a high. It breaks out from a high, but it fails to hold above that high, and then it starts trending down, and then you kind of get a break to the downside. And that's one of my favorite trades, because you've seen what the market tried to do. It failed to do that. It failed to break out to the high, and then you trade the failure. And that's it's a fantastic trade to take. And that's what I mean by market energy. I don't know if that helps explain it a little bit more. If it doesn't, write back to me and I'll try and do it again in another video. But that's what we're ultimately looking at there. The next question is from a gentleman named David, and he said, my question is quite simple. What time frame would you mark your support and resistance zones on for trading the 5-minute, 15-minute, 30-minute, 60-minute, and 240-minute chart? Is it recommendable to mark the immediate one up, meaning for the 15-minute, for the 5-minute, and so on and so forth? Now, in terms of marking support and resistance levels, the first thing you need to understand is the shorter term the chart time frame, the less reliable that support or resistance level is going to be. What I typically do is I will start with the weekly time frame. I will look to see around the price area that you're at, okay? Because you don't want to have millions of different lines on your chart, because then it gets ugly and you don't really know where you're trading from, and you also get lazy. You don't add other lines to your charts. You don't take them away when they become invalid. You just kind of leave them there forever. So the first thing I do is I will look at the weekly chart, and I will look for the major levels in and around the price that I'm trading at, okay, because they're the most important levels. Then I'll jump down a time frame to, let's say, the daily, and pick out any levels there, then the 4-hour and the 60-minute, and so on and so forth. I typically won't go much lower than the 60-minute chart, unless I'm trading like, the 1 minute or something like that, in which case I might take levels from the 15-minute chart. But generally speaking, even if I'm trading, let's say a 5-minute chart, the levels I'm going to want to trade from are going to be on the 60-minute and above. So it's not quite a case of, picking your levels. I'm trading a 5-minute chart, so I'm going to have my levels on the 15-minute chart, or I'm trading the 15-minute chart, therefore I'm going to look for my levels on the 60-minute chart. That's not really the way that it works. Well, for me anyway. So I would start, in summary, I would start with the longest term time frame that you can get your hands on, so possibly something like a weekly. Mark out the immediate levels around the price there, then drop down a time frame again, and again marking the levels whilst you do that. And that will give you a clearer picture of what the significant levels are in and around the price that you're trading at. And it also has an added benefit of, when you do that, you're then starting to get the overall market context. You're getting the bigger picture for what you're trading in. So if you're trading a 5-minute chart, for example, and you've seen that on the daily chart there's actually a massive level there, you wouldn't really want to trade into that level, and you're already saving yourself money just by doing that. So I know it's not sort of like the black and white answer that you're looking for, is in 2 orders of magnitude above, or through whatever it may be, but that's the way that I go about marking up my support and resistance levels on my charts, and I hope that helps you. The final question for today is from a gentleman called Stephen. There's lots of gentlemen today, no ladies. So please feel free, if you're a lady out there and you have any questions about your trading, feel free to send them in and we will make sure we answer them on the show. So anyway, Stephen says, if you have identified a potential buying or selling opportunity and are just waiting for the appropriate level to be breached, if it didn't happen immediately, how long would you wait for this to happen? Days, weeks, months? Stephen, the answer to that, again, it's not black and white, unfortunately. I know us as traders, we like things to be black and white. We like there to be hard and fast rules because that's easier to trade, right? But what you'll find, as you progress in your trading careers, a lot of successful trading, it isn't black and white, it isn't a science, and it is a bit more of an art. And that is there's where we're going to the answer to this question. So in terms of how long do you wait, it's not a period of days, it's not a period of weeks, it's not a period of months. It's until the setup that you're looking at becomes invalid. And the way that it becomes invalid really depends on what your rules are for that setup in the first place. So, if you're looking at support and resistance levels, and let's say you're looking at a sell opportunity through a resistance level, then you've got another resistance level higher, you may say, well, if the other high is broken, then this setup is no longer valid, and therefore that trade comes off the table. But for as long as the price remains within that zone, so to speak, then it's still a valid setup, and therefore if the price breaks through that level, then you'd still be willing to take that trade. So the answer to your question is, it's not, days, it's not a period of time, it's until your setup is invalidated. And once it's invalidated, then you would basically move on to the next opportunity. Okay, so I hope that answers your question. I hope you all got a lot of value out of it. Not just the people that ask those questions to start with, but all of you watching these videos right here, because that's really what these videos are about. We know that many of you have very similar questions about the markets, and these videos here are put there in a bid to answer all of those questions, even if you don't know that they're your questions right now. Okay, so thank you very much for watching, and I'll catch you in next week's Trader Q&A. Take care now.